The 2026 federal budget just rewrote the rules on property investing.
Key things in the sights of the government are negative gearing and the capital gains tax discount. They are two of the most divisive issues that have been blamed for fueling Australia's housing crisis.
The 50% capital gains tax effectively gone. Negative gearing restricted. If you own property, plan to, or simply pay tax in this country, this episode is essential listening. I'm your host, Dr. B, and welcome to another installment of the Investing for Doctors podcast. And today we're cutting through the political noise to tell you exactly what has changed, who the changes hit, and what it means for your financial future. So let's get into it. I think the first topic we should talk about is the changes to the capital gains tax discount. Now, in the last couple of weeks, there's been so much speculation about what Labor is actually going to do in this budget. And there's been talks about changing the discount from 50% to 33%, or getting rid of it completely, whether there's going to be grandfathering in place, or how does that work, etc., etc. And I think we finally have the answer. And a lot of clarity is essential in this space. So what has happened? So the long and short of it is that the capital gains tax discount is effectively gone for established properties from the 1st of July, 2027. And from now to then, there's been some sort of arrangement to allow a staggered process to happen. We will go into a bit more about that later. So what does the capital gains tax discount get replaced with? Now we're going back to the system that was before 1999, when the capital gains tax discount was first introduced by the Howard government. So the old method of calculating was actually what we called the cost-based indexing method. And that was something which allowed you to calculate what your real capital gains was, net of inflation. And we're essentially going back to that system. First of all, we're going back to cost-based indexing to find out a way to calculate how much real gains you've made in your property. And that real net gain will then be taxed at your marginal rate with a minimum rate of 30%. So that means if you are someone who is on lower tax bracket than 30%, you're going to be taxed at 30% anyway. All right. Now, what does this mean? It means that we have moved away from a discounted tax of what we call nominal gains, or the gains in absolute value, to taxing real gains on a one-to-one basis. Now, I believe that that is a better way to tax gains, because you don't want to be taxing people's inflation. You don't want to be double taxing people, essentially. So the next part of it is that who does the new changes apply to? It applies to all capital gains taxable assets held by individuals, trusts, and partnerships. It excludes specifically assets held by companies, because companies were not eligible to receive the capital gains tax discount anyway. Now, this actually applies to all assets. That's right, everything. So it includes those assets held or purchased before 1985, when the capital gains tax was first introduced. Obviously, there are transitional protections in place for existing investors. So first of all, the changes only apply to gains arising on or after the 1st of July, 2027. So everything before that date is still under whatever system that applied today. So for instance, if you hold an asset after 1985, when first capital gains tax was introduced, you can apply the 50% capital gains discount to whatever growth you had up until the 1st of July, 2027. And afterwards, future gains will be under the new system. All right. So for assets that were acquired before 1985, the gains arising before this date will be fully exempt from capital gains tax. But unfortunately, after the 1st of July, 2027, it will start to accrue capital gains tax liabilities. So what does this mean? It means that if you hold a property right now and come 1st of July, 2027, I believe everyone should have a formal or informal valuation to lock in your capital gains that is under the old system, so that you have a new cost basis to start on from the new indexation system. Now, this doesn't apply to certain caveats. All right. So there's a special carve out for new housing. So investors in new residential properties can actually choose between the 50% capital gains tax discount rules or the cost-based indexation plus 30% minimum tax rules, which is the new rules. This is very interesting actually, because it feels like people believe that the 50% capital gains tax is still, gives you the best bang for buck. But in later on, we'll do some maths and actually, talk about this a bit further. So there's also special exemption for those receiving income support. For instance, those on the age pension, disability pension, and other income support payment recipients are actually exempt from the 30% minimum tax rate. So that's pretty much what the changes to capital gains tax is. And as I mentioned, this applies not just to housing, but also for shares. What this really means is that there's going to be a lot less speculative investing on properties and as well as shares. And I honestly believe it would affect share investing a lot more than property investing, because housing prices tend to grow on a steady basis. Now, before everyone starts crying about this loss of capital gains and how it's going to massively hit the housing market and it's going to be the end of the housing market, etc., let's look at some numbers and maths and see what actually happens if the new rules were applied. Now, I took some figures from the last 10 years between 2015 to 2025, and I looked at mainly two figures. All right. So I looked at the cumulative inflation figures, and I looked at the sort of changes in median dwelling prices across Australia. So the national data, which I managed to get from CoreLogic data. So if we actually looked at inflation figures between 2015 to 2025, Australia had about cumulative 32% inflation, which comes roughly to about a 2.8% yearly inflation compounded over that period of time. All right. Now, when we look at the cost of dwelling in national data across all of Australia, in the same period of time, median dwelling price actually rose by 66%, or 5.2% per annum. All right. And what do you notice there? You notice that the price of housing actually grew roughly twice compared to inflation. All right. And now let's assume that the new cost-based indexation that Labor is going to utilize to adjust for inflation is actually based on the same inflation data that I just given you. Then an investor will actually need to pay capital gains on the net of that. So 66% minus 32%, which is 34% real capital gains. What do you notice? That's roughly just above 50% of the nominal gains anyway. So what we're trying to say is that if you apply this new cost-based indexation rule and tax the real gains, you end up roughly with very similar numbers under the new system compared to the 50% capital gains tax discount system. So that's interesting, isn't it? Now, what we're going to see in the next couple of years, especially with the current war in the Middle East and all of the supply-driven inflation that we're having around the world and in Australia, we might see a day and age where the growth in inflation might actually outpace the real growth in housing prices. So that means, you have X amount of increase in housing prices, but more than half of that is actually due to inflation. Now, in that situation, the new way of indexation is actually more beneficial to investors if you held these properties over a long period of time when you allow inflation to take place. And that's actually good. Who it's not good for is probably the speculative buyers who buy in low, do a bit of renovation, and then generate a lot of capital growth, and then to sell within, after 1 year and pay very minimal tax on the gains. I think those are the people that's going to be hurt. So, the buyer the investor builder who goes in, buys a really crappy house, does a makeover, and generate gains, those are the ones that's going to suffer under this new capital gains tax regime. Obviously, the other loser in this is going to be the the crypto speculators and the share market players. And I think that's something that's not actually really mentioned right now, because everyone is so focused on housing that they forget that this loss of discount is actually going to hit equity investors way more than those buy and hold housing investors. So for instance, if you bought, say, Nvidia stock, and in the next 12 months it grew by 20% and inflation was at 5%, you're going to be paying a lot more on your growth. And the funny thing is that right now I'm not seeing people going in upheavals about this, which is interesting. But anyway, that's my take on capital gains tax at this stage. Obviously, there's going to be a lot of mechanistic things that are going to come in place. But fundamentally, and I honestly believe that this is actually the right way forward, because it actually reduces speculation, but at the same time, it is encouraging investment into new builds, which is actually what the government and what we actually want in Australia, is to allow new builds to happen and not really, overinflate the housing market as we've done over the last 2 to 3 decades. All right, so we've talked about capital gains tax. The next thing that the government has really hit out is negative gearing, and they have completely reformed negative gearing. So again, from the 1st of July 2027, negative gearing on established residential property is going to be restricted. All right, so losses will only be deductible against rental income or capital gains from residential properties. The losses cannot be offset by other income, such as wages. All right, so what this actually means is that they have essentially quarantined negative gearing to sort of gains that is not wages. And again, they're only applying this for existing residential properties. All right, so who does this apply to? Now, this applies to every established residential property acquired from budget night onwards. So those acquired before this time, or those who are in contracts but have not yet settled, are grandfathered under the old rules until they're sold. So all of you guys who rush to get a contract signed before budget night, kudos on you. You've managed to get your foot into the door. Now, there will still be some situations where you can still negative gear, and that is really for new builds and eligible new residential properties. They will be allowed to retain full negative gearing and all of these incentives against wages. All right. So there's going to be a number of other special situations where you're allowed to negative gear. For instance, build to rent developments. There's also going to be property held in sort of what we call widely held trusts or superannuation funds. And there's also going to be for special situations where there's private investors supporting government housing initiatives. All right, but those are sort of not what the average Australian investor is going to be impacted by. So those are special carve-outs where you can negative gear for certain government initiatives and government goals. So what this reform actually is doing is not getting rid of the concept of negative gearing. I've spoken much about this in the past, that negative gearing is actually not just one thing. It's a number of things added together. It's about, borrowing money, which is the gearing component. Being negative, that means you're running the whole asset as a loss because your cost of borrowing, cost of operation and everything exceeds the rental yield or income you're getting from a particular asset. And when you run negative, then the third thing is that you're allowed to deduct that loss against wages. So the only thing that they've gotten rid of is that deductibility against wages part. So they've essentially now quarantined negative gearing or investment losses within its own category, similar to how we could never deduct capital gains losses against our wages, right? So comparably, this makes sense. because what's actually happening in the past is that the taxpayer, the wages have been going offsetting the losses that investors are having, and those losses are because of low rental yields, high interest rates, and also depreciation. Now, depreciation is one which really allows someone to reduce their cost base, enter negative gear. So basically, you are tax deducting your capital component and then you apply the 50% capital gains tax discount to, reduce taxation. Now, that was always thing that didn't really make much sense in the tax system, and that's why it also fueled that excessive negative gearing into properties. I'm sure everyone has seen those ads about how you can pay less tax for your investments and how holding investments cost a lot less. And what that actually happens is that when you can pay less for investment, it allows the capital component, the price of everything, to go up. So in a way, that's where the government's coming from. It's to stop making these sort of investments in over speculation and in a way driving up the cost of housing, because losses are socialized actually by the taxpayer and the entire tax base, because you're not paying as much income tax. All right. So now that it's quarantine, what does this mean? It means that your losses can be carried forward and to be used in future years. So for instance, in a new property which you've just purchased, you're running, say, $5,000 short every year. That retains in this sort of an account, or say investing account, where you're negative, and then in future years where you actually start making money, you don't have to pay taxes on those profits because you've had these losses that are carried forward into the future. So in a way, you made it essentially very similar to running a company, because what happens in a company, you actually have you can run a loss, and then you can carry your losses forward to be negated against your profits in the future. So they've just made negative gearing very similar to how a company is run in that way. You can't deduct it against your wages anymore. So that's essentially what has happened in the space. Now, we've gone through both the capital gains tax changes and the changes to negative gearing. What does this mean when put together? All right. It basically means the current strategy of getting your property negative gearing as much as you can possible, perhaps even throwing depreciation in there to maximize the negative gearing. That strategy is dead. All right. That strategy might still apply if it was for a new build, but for by and large, for every existing dwelling out there, this strategy can no longer work because it just does not make sense anymore. And we have to go back to a strategy where you focus on yield, not overpay for properties, and accept really terrible yields, because we know those yields are going to be offset by the negative gearing we have. That strategy is dead. Okay. And the people that this is going to affect is essentially those mom and dad investors who want to invest in, getting their first property or getting their second property, and they're investing under their own names. And the only reason they're investing in their own names because it's easy to get the capital and the loan to do so, and negative gearing against their wages to pay less tax. All right. So the long and short of it, negative gearing to afford a place is dead, because that's essentially socializing sort of the cost of paying too much for a property, paying too much interest when getting much lower yields. Right now, investment yields are somewhere sitting between 3 to 4% if you're lucky, and interest rates are probably sitting at 5.5 to 6%. So before you even start, you're already losing money. And then now you factor negative, cost, strata, if you're in an apartment, insurance, and all of that, you get hugely negative at the start. So that strategy doesn't really work that well anymore unless you have the cash flow to pay all of that. And and what happens is you accumulate all these losses so that you can then offset that in the future. All right, but a loss today is a lot more costly than the same amount of gains you have in the future because again of inflation, right? Your losses are not growing with inflation. So the strategy for how Australians have invested in properties for the last 20 plus years is essentially dead on arrival. Now, what is still possible is to use this strategy for new builds and new dwellings. Okay, so such as off the plan, land and build packages, etc., etc. Right, that still works, and I believe that those opportunities will still be viable under this strategy. But again, do not overpay for a new build because that's the biggest problem. You should not be looking at just the tax incentives and ignoring the fact that you might be overpaying for something. All right. But what the strategy doesn't really change is it does not stop those guys who have 10, 20 properties. All right, because most of those people are not investing in their own names anyway, and they're not relying on negative gearing. So what happens is that now there's going to be a much higher barrier to entry. But once you get into the property game and you are actually positively geared, it makes it a lot easier because every property you add into that, which is negatively geared, that's just offset by your gains anyway. So what this really does, it does help those who have a few properties already because it doesn't really change much for them anyway. And often they're using structures to invest. Now, in terms of structuring, what's going to also happen is that I believe that people are going to invest less and less with trusts and more with under a company structure. Because, as under a company, you have the same capital gains tax system, but you're only paying 30% tax on whatever gains you're making. And then those tax that you pay are then ultimately are able to be passed on to the individual as franking credits. All right. So I believe the future of property investing is going to be using holding companies or investment companies that actually holds properties. But again, you got to make the cash flow work for you. You can't be so negative within the company that it's very difficult to get out of. So what that promotes is it actually deleverages people and it promotes people from paying down the principal more or going in with a much lower loan to valuation ratio so that the property is not running too negative. Okay, and obviously that will be the same case for outside of companies, within your own name, etc., etc. It will stop that high leverage investing that we're seeing right now, where people are leveraging, 80, 90%, 95% even to get investment property, and then rely on negative gearing. So those days are gone. I foresee that a lot of properties will be on the lower geared, and which actually generates less risk and less steam on the market because one of the reasons why prices have gone up so much is that people are borrowing more and more money because they know that they can afford it due to negative gearing. All right, so I believe that this is fundamentally the right direction to go. And a lot of people said that the capital gains tax discount was the bigger problem. I fundamentally believe that negative gearing is the bigger problem. All right. So, a lot of people might disagree with me, but I feel that negative gearing is actually the bigger cause because you negative gear and then you put depreciation on it. So you get extra tax saving and that just distorts the whole system. All right. So now looking at how things are working today, I might even say, is depreciation even worthwhile anymore? All right. And I haven't fully done the maths for that, but I believe that And we don't know the full mechanism of how depreciation works in this new system, because if I am depreciating too much, I no longer get the capital gains tax discount, so that I end up getting taxed at the full marginal rate on the decrease in cost basis. All right. So it means that your cost basis will still go up by indexation, and then you take away the absolute amount from there, and then you get taxed at your nominal rate. So it really becomes okay, we're saving some tax to like, where is the benefit of depreciation in this game now? I believe it may not exist as much unless you're really positive gear. Then you might be able to pay less tax on it and defer it as long as possible. So I think that's one area that I will look a bit further into, and we should all explore going forward. So obviously, there are a lot of other items covered in the budget today. For instance, the minimum tax on trust distribution. We don't know whether that is going to get passed or not, because that's something that has not been very well received. But Labour absolutely has a majority in both houses with Green support. So let's see what how the passing of all these legislation go. But I still firmly believe that the capital gains tax and the negative gearing changes are beneficial for the country, and that they will probably end up becoming legislation. So, if you are planning to invest in property in the future, know what the new game is. And the new game is going to be very different from the old game. So thanks for listening in, and I hope that this will help those who are really confused about what's happening to capital gains tax and negative gearing. And to be very honest, I still firmly believe that the capital gains tax changes are not as terrible or as big as it's made out to be. Whereas the negative gearing thing is probably have bigger implications on property investing. All right. So thank you for watching. There's still a lot to unpack from this budget, especially along these lines. And we'll be doing a bit more modeling and doing a few more numbers to see exactly what are the future ways that one can invest in properties and other asset classes that are susceptible to capital gains tax. Thank you for listening. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.